Hi, everyone. I'd like to thank you all for joining us today for this McGill New York Finance Group sponsored webinar about current economic challenges and what that means for your investments. I'm Allison Davidson. I'm an investment banker for not-for-profit healthcare clients at Morgan Stanley. I obtained my BA from McGill in 2002, studying international relations and economics. I'm currently a member of the McGill University Regional Advisory Board, US East Coast, and the McGill New York Finance Group. McGill really taught me a lot about what it means to be a self-starter and that we're all in control of our own destinies. I used this experience to pursue a career on Wall Street despite the headwinds of my 2002 graduating class year. 9/11 terrorist attacks, the tech bubble bursting. Yes, there was a tech bubble way back then. Limited international recruiting, etc. With every interview in New York, I noticed people really knew McGill. They knew the name, even at my first job as a waitress at Applebee's in Times Square. Ever since, I've been committed to supporting McGill and ensuring it will continue to compete in academics, research, dare I say athletics. Obviously, there's no better college town than Montreal. The purpose of the McGill New York Finance Group is to bring together a curated group of leading McGill alumni who are making a difference in the finance industry in New York. The New York Finance Group is created for and from its members, playing a key role in supporting and expanding McGill's finance ecosystem through active networking and regional events with industry experts and leaders like we have today. More information will follow after the webinar for how to become a member. Some of you may already know that McGill recently celebrated a major milestone. On March 31, 2021, the university officially turned 200 years old. That means 201 is this week. McGill's been hosting bicentennial events and activities throughout the year, most of which have been online. However, in recognition of McGill's third century, the US East Coast Regional Advisory Board, along with the Friends of McGill University, Inc., are hosting a very special gala event in New York City on Monday, May 9th. It's almost a month away at Guastavino's. We're excited for the McGill community to come together from across the US and beyond to celebrate. It'll be a special time to reunite with friends, fellow alumni, and recognize the achievements of McGill alumni. The gala is expected to draw up to 500 attendees, with prominent guests including McGill alumni, corporate sponsors, friends, and donors committed to McGill. Our host for the evening is Adam Gopnik, BA 1980, Doctorate of Lit in 2013, infamous New Yorker writer and award-winning author. Information is available at the McGill alumni webpage. Another link for that will be shared after the webinar. Please join us and purchase your tickets today. I think we're over 70% committed so far. You may want to put together a table with your former classmates. 10 seats is at a table, but they're selling fast. This brings me to the introductions of today's speakers. Moderating today's event is Professor Christopher Ragan. He's an associate professor and the founding director of McGill University's Max Bell School of Public Policy. He's chair of Canada's Ecofiscal Commission, launched in 2014 to identify policy options to improve Canada's environmental and economic performance. He received his BA honors in economics from the University of Victoria, his MA in economics from Queen's University, and a PhD in economics at MIT. We also have three panelists. First is Robin Zivik. She graduated with a Bachelor of Science from McGill. She's a managing director of the Financial Solutions Group, the US region at CIBC Capital Markets. She oversees a team of 30 professionals in New York and Toronto and is responsible for the cross-asset capital market sales and execution strategy across foreign exchange, commodities, fixed income, derivatives, quantitative investment strategies, and structured notes solutions for a range of institutional clients across North America. Mark Taborski is a founding and managing partner of Marker Tree Capital, an investment firm specializing in creating and managing custom and thematic investment portfolios for institutional investors. He has over 25 years of investment experience. He holds an MBA in finance and policy with honors from the University of Chicago Booth School of Business and a BCom joint honors in economics and finance with first-class honors from McGill. And Jennifer Fraser is the founder and CEO of Commodity Risk Associates, CRA, a specialized consulting firm based in Switzerland that focuses on procurement transformation and optimization for raw materials, indirect commodities, and packaging in the consumer goods sector. Prior to launching CRA, Jennifer held senior investment leadership roles with many of the world's top-ranked commodity investment firms and trading houses, as well as serving as the OPEC Technical Committee. She holds a Bachelor of Science from McGill, an MBA from the University of Toronto, and an MA in History from the University of Montreal. So with that, I'll now turn it over to today's speakers.
Thank you, Allison, for that introduction. Hello, everybody. My name is Chris Ragan, and we've got, I think, a great discussion planned for the next hour and a little bit more. At a high level, I think what we're going to do is talk about what's going on in the world economy, and there's a lot going on in the world economy. There was even a lot going on in the world economy before the last month started. But we will talk about what's going on in the world economy. We'll do it from a few different perspectives. And then we will end our panel discussion with trying to wrap it all up as what does this mean for you as either an individual investor or perhaps as an institutional investor. So let's start by talking about what's been going on in the past 2 years. Now, as we all know, a global pandemic hit the world in early of 2020. And it is now a little bit less early in 2022. So the pandemic has been going on. That created a massive economic collapse in almost every country you can imagine. As it turned out, a vaccine ended up being a rather important part of an economic recovery because we've now seen most of the economies recover, some a little bit below where they were 2 years ago, some a little bit above. In the last year, we've been talking about disrupted supply chains. We've been starting to talk about inflation. So I guess my question, and I'll start with Jennifer, could you give us just in 90 seconds or so, what is the key thing that you take from the last 2 years about either things that we should be talking more about, things that we should be worried about, but what sort of thing in the past 2 years do you think really needs to be emphasized? Jennifer, and then Mark, and then Robin.
Well, I think it's about supply chains. And if you reflect on the last 2 years and what happened, COVID was a supply chain problem that we're still dealing with today. I mean, I think people see the stories in the news all the time. None of the containers in the world are where they're supposed to be. So the logistics problem became a supply problem and became a demand problem. And if you reflect back over prior inflationary periods, very rarely did you get hit with all of this at once. And I would add one other thing. It's also a people problem. So we talk about commodities, we talk about freight, we talk about supply and demand, but we aren't also talking about that coming out of COVID is there's just a people shortage for everything. It doesn't matter where you're looking for talent. And that's making solving the three other problems very difficult.
Great, thank you. Okay, Mark, same question to you.
Yeah, so for me, and maybe it's because I've had more time to be thinking about this, my focus has really been on, for an investor, what does the world look like post-COVID? And, what does work look like? Do people go to offices anymore? What does school look like? And then, for all the businesses that depend on what the world looks like, how does that play out? What happens to the travel industry? What happens to small business? What does real estate look like? So for me, at least now, thinking about how is COVID ending, at least it feels like you can see a bit of a light at the end of the tunnel, at least in the US. That's really been my focus.
What does the world look like? Okay, I suspect we're going to come back to what various parts of the world look like as we go over the next 40 minutes or so. Robin, can I come to you now for the same question?
Absolutely. So I'll tie in both what Jennifer and Mark have highlighted. Unfortunately, as COVID hit the global demand as well as supply chain disruption around the globe, the risk, as Jennifer points out, is inflation is supply driven as opposed to demand driven. And so as we were coming out of the economic cycle and reopening economies, workers were returning to the workforce. We all of a sudden were hit with the Russian-Ukraine invasion to further highlight the commodity interdependency around the globe. So we're now seeing it at the pump and the retail level to further highlight that the low risk demand environment that we're in has the risk of actually stagflation around the globe. And it's driven by supply inflation as part of the commodity cycle.
Well, look, we've got a section later to talk about inflation, but maybe given what you've just said, maybe we can talk a little bit about it now. So there's a lot of discussion about whether the world is returning to a state like we experienced in the early to mid 1970s with stagflation, which was high inflation and low, if not negative growth. Robin, just on that point, do you think we are in that world of the 1970s, or is there something very different going on? And I'm going to ask the same question to Mark and Jennifer.
I think we are similar in terms of that it was the supply disruption that's really driving the overall current economies. This today, dollar yen hit the highest rate in 7 years. So as energy importers are having to deal with U.S. dollar term inputs, we're at a very tenuous balance in terms of the global economies and the dollar input and the energy costs for those countries around the globe.
So let me ask then, Mark, I'll come to you. What Robin just said, I'm going to ask Mark to interpret, to get inside Robin's head here. Would Robin have said what she just said a month ago, that it was supply-driven inflation before we have seen what's happened with Russia's invasion of the Ukraine? Mark? So that's maybe unfair to ask you what's going on in Robin's head, but I want to share the wealth here in terms of asking questions.
Right. Mark? Well, I guess, for certain commodities, right? I think a lot of the supply problems prior to the invasion, you saw them in consumer goods and so on. Now, with the Russian invasion, the big problem is the supply of oil, right? And especially the supply of fuel to Europe. So, the biggest the hardest thing, certainly for an investor, about, trying to make a decision today is it's so hard to predict the future, right? We don't know how the invasion is going to end. And so much of the inflationary worries we have are focused on energy. And, how this thing ends is really going to determine what happens with inflation. But, that's definitely what's happening now.
Jennifer, your opening comment was it's all about supply chains. You have a killer graph. Do you want to share that with us now? Because I think it speaks to the supply chains. It also speaks, I think your time period on that killer graph includes some of the last month, but maybe I'm wrong on that. Okay, Jennifer, why don't you take us through that and talk about supply chain inflation?
Okay, so what I did here is I put up, thank you, Visual Capitalist. It's basically key energy components, right? And, I would just add that long before the Ukraine crisis happened, there was already a problem. And the Ukraine thing just put it front and center and bubbled it to the surface. So if you look at what's at green, that's the 2021 year-on-year inflation. So, the TTF, which is European natural gas, is up 290%. In North America, fortunately, it's only up 100 and something percent. You look at these numbers and they're crazy, right? Because you read like headline inflation is 7.9%. So one thing that you have to think about is energy is in everything, right? And people don't think about that. They think about, what am I paying at the gas tank? People don't really see it in their utility bills. But, just to sort of highlight something, that box that your stuff from Amazon came in, that's made of linerboard. In Europe right now, natural gas is about $30 an MMBTU. It takes 30 odd MMBTUs per ton of linerboard to make linerboard. So that means it costs $900 for boxing material that only sells for $900. So obviously box merchants are going to be pushing that cost through. So my point with this slide was all of this stuff is going into stuff that we buy and consume. But just because some consumer goods, the price lag to make it to you, it's 60 to 120 days, even more, because people can't change prices as much as they would like. So my point would be that inflation is a lot worse than anybody thinks.
Well, that's very uplifting. Thank you, Jennifer. So
you're welcome.
So, okay, you want to take the slide down then, please? And that's great. So let me just ask one final question on the inflation, because Robin talked about both aggregate demand and aggregate supply shocks to the economy. When I think back to the early to mid 1970s, there were two very large commodity price spikes, one in 73 or so and one in 79 or so. And those were largely caused, I think, by reductions in the world supply of oil and other commodities. Okay, but the big one was the OPEC price shocks. Whereas this one, the data that you just showed us, Jennifer, was 2021. It was all pre the Ukraine invasion. And that was, I would have thought that was largely demand driven as the economy was recovering from a point of very low demand and low energy demand to much higher activity and much higher energy demand through the end of 2021. So number one, is that right? And number two, does that distinction matter? Any of you that want to jump in on that one?
Well, I think the way you have to think about it is it's like a cycle that feeds on itself. So coming out of the COVID, yeah, there was a huge spike in demand and people had already shut down production. They lost all kinds of employees. It doesn't matter whether, it was farming, energy, metals, whatever. People couldn't work. Their immigration was shut down, people who are normal. But then that became, a demand, right? So I think, people have seen this in, for example, the housing market, and it really doesn't matter where you are. People are doing this. If you're going to work from home, you don't want to do it in a 400 square foot apartment. You want to do it in a house. You move from a 400 square foot apartment to a 2,600 square foot house. You consume a lot more of everything. And so then, so we continue to have these problems, and they're just like cycling on top of each other, making it worse. And then, if we look at what, just to say on the chart, was 200%, well, you can slap another 75% on that in natural gas since this crisis started. So we have a lot of issues, I guess. Okay,
Mark, and then Robin.
Yeah,
anything on the supply, demand, inflation numbers?
They say the best way to solve high prices is to have high prices, right? So at some point, the demand for these goods whose prices have been going up a lot should correct. So I guess while I'm concerned with high energy prices, I also think that there's a natural correction mechanism in there that will make this episode of high inflation, dissipate over a shorter period of time. Like, I don't see us at $150 a barrel oil for a really long time, if we were to get there.
Robin?
I think the risk is, as Jennifer's pointed out, they all happened together concurrently, from a supply issue to a demand issue. So yes, you can fix high prices with high prices, but that's if the demand side of the equation is what's driving our issue. But as Jennifer's pointed out, it started with the supply side of the equation as it relates to logistics and actually getting the goods and services to the places that it needed to be, which is based off of talent and workers.
Okay, let's switch away from inflation. We'll come back to inflation in a bit, but I want to talk about volatility. Now, most investors, unless you're a daytime investor who's playing the volatility, a day trader, most investors, I think, as a general rule, dislike volatility. And even before the Russia-Ukraine situation happened, there were lots of volatilities out there. We could talk about the commodity prices that were spiking. We could talk about what's going on in China, in particular, I think, in real estate these days. But who wants to talk about volatility and a type of volatility that's out there that concerns you? Robin, can I start with you?
Sure. I think that volatility is absolutely a concern for most investors because there's no assurance in terms of the valuation of your portfolio at the end of the day. Everyone's fixated to CNBC and where prices are moving across a variety of marketplaces. So I think that in terms of putting protection into one's portfolio, either from a diversification mechanism or a protection to your overall basket of investments through some downside hedging protection is definitely an area that we've seen pick up from a client perspective, both from an investor perspective, as well as from a corporate client looking to hedge and manage the volatility of their inputs. That's a business that Jennifer's very well versed in.
Well, let's turn to Jennifer and then Mark on the same point. What's the volatility that concerns you?
Well, I think if I think about what I do for a living now and my clients, it's the unknown of, will you have that supply? So there's the price volatility of what is your input cost, and Robin's right, people are running to have hedging programs on the consumer side that we haven't seen consumers out hedging like this in, a good 2 decades. But the bigger problem for everyone, that, or at least for my clients in the consumer goods world, is how are you going to get the material? So think of something like sunflower oil that's not going to get planted in Ukraine. That goes into all kinds of cookies and other things that we all eat. Now you've got to change your blend flex. Now you've got to go get some other vegetable oil. And so does everybody else. And so how do you plan? How do you plan a production cycle if you don't even know what you can get in your factory?
Mark?
Yeah, so
Mark's got the answer to that.
Yeah, so my view is, but before I did what I'm doing now, I spent a lot of time investing for endowments. And endowments don't care, or long-term investors don't care as much about daily volatility. They try to ride through this noise and try and figure out if it's noise or if it's real. I think the volatility that even concerns them sometimes is when you look at things that are, high quality stocks or high quality bonds that should be stores of value, that should be relatively stable. They sometimes get worried when things can be up and down 5% for no reason. So I think when the market loses liquidity and people wonder if there's going to be a run on assets, I think that's where the concern is. But I'd say, by and large, not everyone thinks about volatility as risk, right? And I think if you're an investor, you need to pull yourself away from stuff that's noise and focus on some of the longer term themes that's going to affect risk in your portfolio.
I think it was Jennifer that said, in response to Robin's comment about hedging on price volatility, is that there's more hedging going on now than has gone on in a couple of decades. Is there a difference in the investment community? So this is a question that wasn't in our list of questions, folks. It just struck me. But in the investment community, is there a sense that people that have been around the block a few times, otherwise known as old people with hair my color, have an advantage today because they have experienced either the 1970s stagflation or they experienced the same sort of volatility that we're seeing now, but 20 years ago? Is there a difference that the young people are at a disadvantage because they simply haven't seen a world that looked like this? Jennifer?
Well, I think you're the economist, so you know that people are forward-looking and backward-looking, and people reference things in their experience. So my experience has been so far through this process is that, yeah, there's a demographic line that you can draw. The people who know who Jimmy Carter was when he said, put on a sweater, and the people who don't. And how that manifests itself, at least in my experience so far, has been, you see older people get scared. That older people were like, this is not transitory. Like 6 months ago, they knew it wasn't transitory. And then when I speak to younger people, it's like, they say to me, well, when prices go down, and I'm like, what's your catalyst? So there's sort of, there's a process you have to go to, which is disbelief, accepting it, and understanding it. And actually, just recently, I've been asked to do, when I do training, a lot more classes on, tell us about inflation in the past. And I think I scared the living daylights out of everyone, and I slapped up a chart of 20% interest rates on how they got out of the last mess. But yeah, there's a real, there's like a historical gap that blocks processing, in my opinion.
Robin, and then Mark. Same question.
I agree with you in terms of there's experience breeds confidence. So we're seeing that as different portfolio managers are choosing people to manage their money, or individuals are looking to asset managers to manage their money. Those that have traded and managed investments in various cycles are kind of put at the top of the list, because a lot of the newer traders haven't either experienced this level of volatility or haven't experienced a bear market in order to manage their portfolio of investments and positions accordingly. So yes, I do think there's a value in the experienced manager.
I just keep looking for advantages for age, folks. Mark.
Yes. I would agree that old people are cool. And
Okay.
I think it's because, if you've lived through, like the global financial crisis, if you've lived through that and traded a portfolio through that, I remember being at PIMCO and people were running out to take money out of the ATM because they weren't sure if they were going to be able to get cash the next day. People were worried banks were going to fail. So, it kind of dulls our senses when we look at screens today and we see, the market's down 2%. It's like, so what? I've been through stuff like that. And, you look at potential catastrophic things and you say, well, I've been through that. Let's be rational about what can happen and what can't happen and the role the government and the Fed takes in this. So I think it helps us think through things in a very kind of calm and logical manner.
Okay. Old people are cool. I think we can all agree on that. And even if you can't all agree on that, I'm the moderator and I'm agreeing on that. Old people are cool. Let's turn to inflation. We've talked about inflation and supply chain and commodity price spikes, and you saw the killer graph from Jennifer. But until the last 30 seconds of Mark's comment, we hadn't mentioned anything about central banks. So let's talk about what central banks are doing these days. Let's talk about interest rates. So we have had interest rates that have been very low since basically the financial crisis in 2008. We've seen central banks in 2008, or several of them, massively increase their printing of money and the purchasing of government bonds and other bonds. So massive expansion in the central bank balance sheets. The Bank of Canada didn't actually do that, but they did do that starting in 2020 with COVID. So we saw another round of what's called quantitative easing. So interest rates have stayed very low. Balance sheets in the central banks have been extremely high. How does that fit into the picture overall? I'll start with you, Mark. How does that fit in with what's driving inflation now? Or is it just a sideshow relative to the supply chains? And what does it mean for you about where you think things are going in the future? Mark first, and then Robin, and then Jennifer.
Right. So I think we're in an interesting period now where central banks look like they may be going in similar directions at different speeds, and sometimes in different directions. And I think the implications of what they're doing, one is a lot of it is challenging our notion of what causes inflation, right? Like the Fed has been buying treasury bonds, billions and billions of dollars worth of treasury bonds, and that really wasn't causing inflation, right? It was more these supply chain constraints that seem to be causing inflation across, if you look at all the components of CPI, it was, across the board. But I think for an investor, it's interesting to look at the rate of change that people expect rates to go up in the US and Europe and let's say Japan. They're very different, right? And the Japanese currency has been weakening because they're saying, A, we don't have inflation. It was below 1% year on year. And B, we don't plan on raising rates for the next few years, whereas the US has inflation and completely intends to raise rates. So I think, for those who have not thought that much happens with FX, now is the time where you're seeing big moves, and that's going to have big implications in certainly international portfolios.
Okay, I'm going to Robin. And Robin,
Sure.
maybe you could say whatever you want to say, but also maybe address part of Mark's statement that maybe central bank actions haven't yet been a cause of inflation, but I guess implicitly maybe they will at some point soon, perhaps.
Okay, so I agree with Mark that for most central banks, the path of, they call it least regret, is to start hiking. So we've started to price that in, at least to the yield curve in Canada and the U.S. I'd shift it over to the past number of years in such a low rate environment. As Mark pointed out, the investors and money managers sought yield any way they could achieve it. So that shift in overall investor base and what assets they're holding on their balance sheet is something that we need to take into consideration as it relates to the holdings of the individual investor and where the risks are as we start to come into a higher yielding or a higher interest rate environment.
Robin, just on that point, are you concerned? I think what you were saying is that the very low interest rate environment we have been in for quite some time has been leading investors to take on more risks in search of yield. Has there been inappropriate risk taking, or has it been eyes wide open, kind of completely acceptable risk taking?
So I can't comment on the individual holdings, but what I would say is that lending, because there was so much capital on the sidelines, there became this mentality of FOMO, fear of missing out on that yield. So you would get lenders, non-traditional lenders, that were kind of giving up on certain risk covenants in documentation in terms of extending their balance sheet and lending to borrowers that might not, in historical terms, have received capital from those types of lenders. So I do think that there are risks that will only start to uncover in a higher yielding, in a higher risk and a higher interest rate environment.
Okay, Jennifer.
Maybe I think what we'll see, this is about the consumer side. So for the consumer side, everyone's waiting to see when demand is going to get dented, right? So is it going to be, can I handle if I'm a Canadian, can I handle a quarter basis point on my HELOC? Probably. I can still keep using that as a giant credit card, right? 50 basis points, 100 basis points, like at some point, it starts to eat in the massive demand surge when people, financing. I think the other thing where it starts to eat in, and we're starting to see it in, let's call it darker pockets of the world, is that cash and financing has a cost, and it may not be available when you need it. So in the commodity world, when people need to finance that cargo of grains or crude oil to move, they're having to put up 80% of the value now. That's a lot of cash. And those people are tapped out at banks. They're now paying very high interest rates in non-traditional lenders. Mark, so that will, cause another problem, right? So I think that what I'm personally looking to see is on the consumer level, when do the central bank interest rates start to hit consumer demand? Because it's not happening with price.
Mark.
Yeah, so with respect to kind of low real rates, search for yield and so on, I mean, the days of having a positive real return, not taking any risk, are kind of over, at least for the moment, right? 30-year tips, the real return is zero, right? So I think what this has forced people to do is figure out, in some ways, are they taking enough risk? Do they really need full liquidity on their entire do they need to be in liquid equity and liquid fixed income and nothing else? Maybe they can take some illiquidity risk because you do get paid for that, right? So maybe some of their portfolio needs to be in real estate. Maybe they should be looking at doing some private investments because there's a portion of their portfolio they don't need for 10 years or 20 years. And this is what institutions have been doing for a very long time. So I think, it's not clear to me people are taking unnecessary risk, but I think people are evaluating, am I taking the appropriate risks, and can I take more without taking too much risk overall?
Okay, I want to ask one more question about central banks, and I want to put you all on the spot to think about what your forecasts were of central bank actions 6 weeks ago, and how those forecasts have been modified with what's been going on in the Ukraine. So, 6 weeks ago, I think most people were watching the Fed and the Bank of Canada and other Western central banks either start a rate increasing cycle, or they were announcing the beginning of one, soon to come. How much has the last month or so changed what we expect to happen? I'll start with Jennifer. You can give quick answers if you like. Jennifer, then Robin, then Mark.
I think it's just been an evolution to the big number comes out in January. They're going to be super aggressive. The war starts. Oh no, we can't go super aggressive because it's double whammy. And now it's back to super aggressive, and something needs to be done. And I'll leave it to the two investment experts to comment on that.
Okay, Robin, and then Mark.
So I'd say the pace and the magnitude has they've taken their foot off the gas. So I would say where we were originally calling for 7, at least from the Fed, that's tapered down to more like 5, and in 25 bite-sized increments as opposed to 50.
Okay, Mark.
I'd agree with Robin. I've certainly expect the Fed to be a little less aggressive going forward.
It's a good example of why different sources of inflation lead to different behavior by central banks. If all of that burst in commodity prices had been driven by demand, I think you would find that the central banks would not have slowed themselves down. But driven by a war, which then leads to huge supply disruptions, pretty good argument for them to take the pedal off, take the foot off the accelerator, or off the brake, I suppose. Let's switch over to energy security and longer term energy transition issues. So, the world, even before the Ukraine started, we were talking a lot about long run energy transition, the need to get away from fossil fuels onto cleaner energy sources. And we can think about what that does, what that means for the world of financial capital and investment opportunities and investment risks. Okay, so that whole discussion, I think, in some sense, hasn't fundamentally gone away. But with the Ukraine, obviously the issue of energy security has raised its head in a way that didn't exist a month ago. Let me just ask any of you for a comment on either the longer run energy transition issues as they pertain to investment, or the short run issues of energy security. Let me start with Jennifer, and then Robin, and then Mark.
Well, I hate to say you're wrong to a professor, but I'll step out there. It's not either or. It's both.
Oh, I agree. Sorry.
So,
and you can tell me, you can say that I'm wrong anytime. That's fine.
It's okay. I'm belligerent enough. So first of all, we have a crisis, and I hate that word because it's overused. Okay, so we need to avoid energy poverty. We desperately need to avoid energy poverty. We need to have energy security, and we need to have energy availability. That's what we need right now. Okay, but we still need to address the long term, and the way you address the long term is we need to change the supply demand mix. So what we actually need is a plan, which we haven't had since this entire conversation. There's a whole gang of people talking about, and we're going to have this technology and this technology and this technology, and it's going to come in on 2035, 2050. We're going to be zero carbon. Pick your date, whoever said it. And then you have another people who on the other side of the spectrum saying, no, we need fossil fuels. You got to drill. And these people don't talk to each other, and there's no plan. So we stop investing in fossil fuels. Now we've got a supply gap, but there's no plan to get from where we are today to tomorrow. And this is the conversation we need to have, because you're going to need, it's a transition. We need transition fuels before we get to, nirvana. So this is, I think, a conversation that can happen more seriously now because the world is united somewhat.
Okay. Jennifer, I'm going to come back to you after we hear from Robin and Mark. I'm going to come back to you for your 30-second description of the highlights of the plan that we need. I'm putting you on the spot because you said the world needs a plan. So I want to hear what you think the plan should look like. But before we hear that, Robin and then Mark on either energy security or energy transition, or indeed both.
So I'll be kind of middle of the road. As Jennifer said, the goal of the utility has always been to ensure reliability. So realistically, that can't be achieved by wind, solar in the current state of our infrastructure. So there does need to be that balance between fossil fuels, natural gas primarily, as well as planning for the long term. And that also allows for greater North American independence from an energy sourcing perspective.
Okay, Mark.
Yeah, I mean, I think, obviously both are super important. And I guess, things that I hadn't thought about before, like I thought about, US energy security is really important, but now the energy security of the US and all of our friends are really important, right? So I guess there needs to be like a global, it's hard enough having a local plan or a national plan. You need kind of like a global plan of how do we ensure energy security for everyone we care about, and how do we transition in a thoughtful way away from fossil fuels to things that don't pollute the environment. It's tough, right? Like even today, if you're charging your Tesla, you're charging a lot of it with coal, right? Because that's where the electricity comes from. So I think if everyone realizes that you can't instantly switch from fossil to non-polluting sources, and we have a global plan how we're going to achieve it, that would be great. It's really tough, right?
Okay, so Mark, it sounds like you'd like a global plan too, but so I'll allow you to comment on Jennifer's sketch of a global plan, and then Mark, you can talk about what you want to add to Jennifer's global plan. Jennifer? I know it's completely unfair of me to put you on the spot,
it's okay.
but I'm going to anyway.
So let me start with saying we need energy security and we need it now. It was a huge conversation 20 years ago, North American energy independence. It was going to solve so many problems, and then that kind of fell off the radar. We need good barrels. We don't need bad barrels from dictators and despotic regimes. And we need an honest assessment of what the cost of a barrel or an MMBTU is. And we can't have these things without considering human rights, labor, terrorism. So we need to stop this fiction that a barrel from Saudi Arabia is better than a barrel from Canada. That, like, right there. Somebody needs to stand up and be honest about that. Any politician. We, in the short term, need to bottleneck every single piece of logistic that we can in North America, because we need to get those barrels and those MMBTUs to our friends so they can stop buying from a terrorist. We're going to have to build infrastructure. Nobody wants to hear this. We're going to need lots of natural gas infrastructure. Natural gas is the transition fuel. We can decrease crude oil. We've already decreased coal, but not really if you think of my slide, because coal's like a rager this year. And then we need to think about what that means for the developing world, because it's pretty expensive to get them to where we want to be in the West. Then you need to have an honest conversation with citizens and say, this is where we are today. This is where we're going to be tomorrow. We're going to need fossil fuels, so don't dream that you're not going to have them in probably my lifetime. And these are all the things we need. And then we have to be honest that to get to all the renewable technologies, we're going to have to spend a lot of energy to get there, because all those metals and minerals that need to be mined to make the batteries and the specialist car parts and everything else, they're very like 40, 60% energy intensive. So we're actually going to have an increase in fossil fuel demand and consumption. We need to be honest about that, but we need to say, we need to sink this cost, we need to make it, and we're going to get there. And here's the realistic pathway. And I'll be super unpopular and say, we're probably going to need to, in North America, follow some of the European examples and start pricing emissions on cars at registration. We've got to get people to change.
Well, you think just that final point made you unpopular. I think you were unpopular after about the first point, but that's okay. That was a great plan. That's a great plan. Now, Mark and Robin, do you want to add anything to the plan? Because we're about to move into the Q&A from the audience. And I've got 4 questions ready to go that are across the board, actually a good selection. But Mark and Robin, do you want to add anything to Plan Jennifer? Because she will be running for world government soon on this plan.
And I look forward to that day. So I don't have anything to add, but I from a prior comment that Jennifer made, in terms of we all have experienced the pandemic. It hit every human being, and we are all experiencing from a different shore, obviously, and have a visceral reaction to what's going on in the Ukraine, that I think we're now at a better point in us having that honest conversation that Jennifer is suggesting, in terms of understanding where energy security needs to be and the cost to get there. So I'm trying to be optimistic with Jennifer's assessment.
All right, Mark.
Yeah, and I agree with Jennifer. I would also add, I think it's important to kind of revisit the nuclear question, right? As to, can we safely operate? And, because that can solve a lot of problems, because that's clean, unless it explodes, right?
Right. So nuclear does come with its own sort of high-end baggage, right. But it is absolutely clean from greenhouse gas emissions. It's got some other stuff. Okay, folks, this has been terrific. I've got 4 questions in the chat box. Hopefully we'll get some more. But the first one is actually about the energy world. So let me ask this one. Is the current increase in gasoline and diesel prices that we are experiencing, and frankly, I think we could ask this as a pre-Ukraine question or as a current, question driven in part by the conflict. Is this an opportunity for the market for EVs, the market for electric vehicles? Okay, you can give quick answers on this. Mark, I'll start with you, then Jennifer, then Robin.
I don't know if the high prices, certainly it's a selling point, right? But at the same time, don't forget that your electricity costs have gone up a lot, right? So charging your Tesla is a lot more expensive than it was before the price went up. But I think, you need all the reasons you can get to get people to be cleaner in their own lives. And, to the extent that that's a selling point for EV, I'm all for it.
Jennifer and then Robin.
I don't think so. We lack a budget EV. That's what we lack to really kickstart the thing. Second, it's not like they can build more EVs because they got a big supply chain problem. And then third, depending on where I live, the price of electricity is up 450% year on year. So no one's running to charge their car.
Robin.
I would agree with both Mark and Jennifer. I heard an anecdote that when there was no supply of used cars on lots, dealers' lots, then people started looking at how quickly they could get an EV, or when they saw the sticker shock price of gasoline, how quickly could they get an EV, and just the waiting time and the supply chain issues there. That doesn't solve the problem.
Jennifer mentioned that we need a budget, a low price EV in order for people to really want to make the switch. And that's probably a correct statement even before electricity went up massively. But my guess is if you ask Elon Musk or GM why they can't produce an electric car that's cheap enough, they would say because there's not a big enough market for them yet, so that we can't scale up production yet, even if we could solve the supply chain problems. So is there a solution to that? Like, how can we can't magically just wave a magic wand and get a budget EV. There's got to be enough, doesn't there have to be enough demand for it so that they can drive the cost down with scaled up production levels? Anybody?
I think we need to make it easy for people, and it's not easy right now. So people of a certain age on this call will remember that parking lots in Canada used to have plugs in them. They had posts so you could plug in your engine so it would turn over when it was minus 40. Okay, they're all gone. So think about the garages that you go in. There's like 10 EV parking spots. What happens when everybody drives an EV? Where are they charging their car when they drive to work, right? And if they live in the city center, where are they charging their car? Because, you know, if you live in the suburbs, you could conceivably run a power cord out your window and charge your car overnight, right? So I think it needs to become easy for people, and there needs to be investment in infrastructure so that it becomes that they're not like, you know, like the highest penetration of EVs is, I think it's either in the Netherlands or Belgium, it's 5%, right? And there might be a Nordic country that's there too, right? But we need to make it normal for people, right? And it's not something like special. It just needs to be normal. And for normal, we need infrastructure.
Anything to add to that before I turn into money supply questions? Mark or Robin?
I would add that, you know, although I don't necessarily think government does everything well, I think this is an opportunity for government to, you know, if this is something where the market can't solve it right away, that government needs to provide more incentives to get people to move in that direction. It's still a big infrastructure problem, but, you know, you can't see incentives going away and still expect this mass movement into electric vehicles.
Robin, final word on EVs or on...
nothing to add. Thanks.
Okay. All right. Then I'm going to go to the second question from the floor, which is about money. So what is the impact of the acceleration of money supply, M2, M3, pick your measure, in the North American and European economies and inflation? So we have seen an increase for sure in your favorite measures of the money supply. How important has that been into driving inflation? And let me just say, we can talk about that inflation over the past year and a half or two, but we can also talk about what we're expecting for inflation in the near future. Robin, I'll start with you. How important is money in inflation?
I think the prior conversation were in agreement. I think that it was started by a supply-driven inflation story as opposed to a growth side of inflation story. So regardless of money supply, it became a logistical issue from a supply chain consideration.
Okay, Mark, and then Jennifer on the same question.
So I think it's not yet clear, right? I think the old theories would certainly tell us, and maybe it's just we haven't waited enough time, but the old theories would certainly tell us that inflation is a quantity of money problem, but we really haven't seen that play out in the absence of these supply issues. Like, I was looking at all the components of CPI the other day, and there's some that are very well controlled. You know, drug prices are like up 2% year on year, but it's the stuff that's super supply constrained that's gone up a lot. And if you look at where kind of Wall Street banks are forecasting inflation 2023, it's not that bad. It's kind of like 2.5% in the US, 3% in Europe, and Japan, it's still like 1.5%. So my sense is most of the issue is, at least with current inflation now, is supply driven as opposed to quantity of money. But we'll see how it plays out.
Jennifer.
I think I agree with Mark, and I think that the number that we all need to be watching going forward is PPI, the producer price index. And I think you're going to see some scary numbers in there.
If I may, I would like to take the moderator's prerogative and add an answer from the moderator on this. I think it's important to note, and I would have made the same statement after the 2008 financial crisis and the massive quantitative easing that took place there. And then we've seen the same thing in 2020, 21, that a huge amount of this increase in money, I mean, M2 and M3 have increased for sure, but a huge amount of the increase in new money has been effectively hoarded by commercial banks in their accounts at the central bank. And that's because there was a demand for liquidity. And I think the way I think of this is that it's when the commercial banks start to lend out that money that it really starts to get into really fast growing M2 or M3, and that's when it will start to drive inflationary forces or drive inflation. But if in fact the commercial banks retain most of that money as hoarded cash under their pillow effectively, then it may not be inflationary. And I think actually that's consistent with the older theories. I think the older theories that Mark alluded to, that money was driving inflation, were, I mean, it's sort of an other things being equal statement, right? If there was no fundamental change in the demand for liquidity, then, you know, massive money printing leads to inflation. It's some of my favorite graphs in macroeconomics. Okay, staying on money and bonds and yields is the third question. The question is the yield curve inverting a signal of a near-term recession? Now, I don't think we are currently seeing an inverted yield curve, although please correct me if I'm wrong. But the question is the yield curve inverting a signal of a near-term recession? Let me start with Mark and then Jennifer and then Robin.
Well, I mean, historically, it's been a good signal, but, you know, with all signals, you kind of ask yourself, is this time different, and what's driving that? And I think to some extent, that's one of the reasons why maybe I've become a little more dovish about what the Fed might do, because the risk of a recession, given what's going on in Ukraine and supply constraints, is probably higher than it was a few months ago. So I'd say, you know, it's a signal, right?
Okay, Jennifer and then Robin. Yield curve.
I'm going to defer to Robin and Mark on this one.
Okay. Then you've got time in the bank. Robin.
Yeah, no, I think as Mark says, because of the uncertainty and because of the volatility of the marketplaces, people have moved their investment horizon to a shorter term investment horizon. So I think that's really what's driving the shape of the short end of the shape of the yield curve. So not necessarily a signal.
Next question is still on money, but it is on fiat money versus the emerging central bank digital currencies. So the question is actually, is the shift from fiat currency to central bank digital currency, what will be the impact of that shift, if that shift occurs? Okay, what will be the impact of the shift from fiat currency to central bank digital currencies? Jennifer, do you want to start?
I don't have an opinion. It's so rare, but I have no opinion on this one.
Yeah, I haven't known you for longer than a couple of hours, Jennifer, and I'm a little surprised at that one. But okay, you've just banked more time. This is very good. You're hoarding your time. This is good. Mark, you're next, and then Robin.
Well, you know, I think it's just going to put certain people out of business theoretically, because if you can move money and it doesn't cost money to move that money, then all those guys who used to make money by moving it are going to be upset, right? So I do think it's going to get rid of some of the middleman and some of the friction of moving money. So to some extent, I think that's a really good thing.
Isn't it
especially in international trade?
Isn't it also likely that it will basically eliminate the reason for the non-central bank digital currencies?
It should eliminate some of the speculation, right? Like
yes.
Somebody was arguing with me the other day, and I have to plug in my laptop, so I'm gonna move it before I get disconnected. Someone was arguing, like, don't you think Bitcoin should go up to 100,000? Because you can move it all around the world, but what about a stable coin?
Exactly.
Right. So all the advantages of Bitcoin are captured by a stable coin. So I do think some of the speculation and the the daily creation of new crypto at some point will stop. And I do think it could be a really good thing if these central banks create these digital currencies.
Right. Robin, you're next.
I think the technology application and the blockchain application to the central bank system is helpful for all. I mean, in terms of access to liquidity at all hours of the day in different underlying currencies. So I don't think it's a replacement conversation. It's more of a ease of access to liquidity.
Okay, we are at the 1 hour mark and we've got a few more minutes. And fortunately, I've got a few more questions. So question number 5 from the audience is, how would you balance an investment? This is a really small question. How would you balance an investment portfolio in the current context? But you all think about this. So who wants to take this on first? I think we'll go for Jennifer.
You know, not in that game anymore, but I'll just give my own personal thoughts on this. It all depends on your time horizon, right? So if you've got a long time on your time horizon, then, you can, be a little more open to trying new things, different technologies, standard. If you don't have so much time and you want to de-risk your portfolio, I'm a large fan of the dividend yield, and pick your asset, pick your sectors, and pick the best name in the sector.
Okay, Mark and Robin.
So kind of along the lines of what Jennifer said, I think, if this last 2 years has taught you anything, it's how much risk you feel comfortable taking, right? And I think that's the jumping off point for giving any advice on what a portfolio should look like, right? I do think people need to take a lot more risk than they used to. You can't just own government bonds and expect to make a good real return. Being diversified, being opportunistic, but the key is just understand, when your stomach feels queasy about your portfolio, how long you can invest for, what's your time horizon, and then be as opportunistic as you feel comfortable being. Some people don't want to do alternatives because they don't understand them. They don't like the illiquidity. They don't feel like they can choose a good manager, but pick what you feel comfortable with. And, have your eye on the prize. What kind of return are you trying to make? And then what kind of risk do you feel comfortable taking?
Okay, Robin, same question.
I would agree with Mark and Jennifer from an overall diversification perspective. I heard another podcast, and the question's always active versus passive, and the answer is a mix of both, because they're going to have different performances based on the market dynamic and the market opportunity. But as Mark says, we've seen a lot of investments into a higher yielding real asset bucket, but you have to understand that there's less liquidity in that allocation, and you have to be okay with that level of illiquidity or inherent greater risk in that commodity real asset real estate bucket, as opposed to the general 60-40 portfolio that most people are used to.
Well, let me stay on the sort of personal investment advice, professional investment advice theme. One of the questions we've got, and we're just down to our last couple of questions now. One of the questions is, if GDP growth is going to be about 2% in real terms, and inflation is currently at 8%, and we don't know how long that's going to last, should we be expecting negative equity returns? So let's think about this. I'm going to start with Mark. What sort of probability do you put on negative equity returns over the next 6 months, 1 year, 2 years? Mark, Jennifer, Robin.
So if that holds, that's kind of stagflation, right? And that would be bad in general for equities. But I think at the same time, when you're worried about inflation, I think you need to tweak your portfolio a little to take advantage of those companies that can, inflation is the result of companies raising prices, right? So you want to be with one of those companies that's raising prices and has the power to do it. So that's not my central hypothesis that I think that way, but I think there are ways to protect yourself by being with the right companies that have pricing power. The other thing I'd say is, you shouldn't be investing thinking 6 months to 12 months out, right? You should be thinking 3 to 5 at a minimum, and view any short-term inflation bumps as kind of just a bump in a much longer investment road.
Okay, Jennifer, and then Robin, and then we've got one final question.
So I think what Mark said is correct. I mean, there's a lot of classical ways to deal with an inflationary cycle, and also given that we have a supply constraint. So the first thing is if you are a real commodity material supplier, that is in theory an inflation hedge. I think that you can't be like 6 months or 1 year. Could we see a year of negative, like broad index returns? Sure. Why can't we have a down year on the S&P, the TSE, or whatever, right? TSX. So I think it's what Mark said, which is you need to be. I think if your time frame is under 10 years, it's going to be very hard just to be in an index. You're going to have to be a little bit more defensive.
Robin?
I would echo what Jennifer and Mark have said. It determines what's your time horizon, and it should be longer. And you can pick your spots. I'm not a stock picker, but you can pick your spots as opposed to being in a broad-based index. And I think that's the underlying message from active versus passive. If you believe that you are going to have 8% inflation and the stock market is not going to perform, broadly speaking, then you need to shift into kind of the large cap names, buy what you know.
Okay, folks, we're down to the last question. And without being Pollyanna-ish, I'm going to invite you all to help me end this event on an up note. And the question is actually asking us to think about an up note. I feel like the question is written from somebody who is, has been like all of us, surrounded by a lot of negative events going on in the world. So this question is, what could be some potential triggers for an economic uplift a few years from now? Let's say around 2025. And, what does the world look like then? Now, Mark actually talked, what does the world look like? He started off with that kind of comment. So what are the kinds of things we could look for or be keeping our eye out for that would trigger an upswing economically in the near future? Jennifer, I'm starting with you. I'm gonna ask you to set the positive tone here.
Sure. So anytime that you have challenging times and tough times, usually good stuff comes out of it. So I think what we're going to see is we're going to find solutions to the problems. So we're going to have greater supply chain resilience. We're going to have greater productivity gains, and we're going to figure out how to do more with less. So I think all of those things are positive. I can't name what they are. I'm absolutely sure there's going to be a whole battalion of new technologies for every industry under the sun, right? That will make stuff, services more effective, higher productivity. I think the only downside is how are we going to transition the people component on that? Because if we're going to do whole scale changes on how we do stuff, then we need to transition people too.
And it sounds like you are a believer in the idea that necessity is the mother of invention, right?
That was the exact phrase I was looking for.
So we're going to solve these problems because we have to solve these problems.
Exactly.
I like it. That sounds positive to me. Robin, you're next, and then Mark.
That's Pollyanna Jennifer. So I would agree that out of this energy crisis, it drives innovation, and we're seeing a lot of investment onto that clean tech market, energy transition economy. So I think that's a bright light in the future in terms of deployment of capital towards those types of innovations, and the outcome is a cleaner environment.
Okay, Mark, you're getting almost the final word, Mark.
Almost the final. Well, before the Russian invasion of Ukraine, I think all eyes were on the end of the pandemic, right? And so much pent up demand and people changing the way they live. And I'm going to travel more. I'm going to do this. I'm going to do that. I think, certainly in the shorter term, I think the end of the pandemic, which feels like it's close, is going to help us in the near term. And in the longer term, I think, what Robin and Jennifer have talked about, whether it's technology or moving towards, a clean energy future, I think a lot of this innovation is going to help us long run. And technology, I think in the end kind of saves us all from a lot of things. And the pace of technological change is amazing. I mean, just look at drugs. They came up with a vaccine in less than a year, right? Think about all the other problems that are going to be solved based on that kind of technological development.
Thank you, Mark. Thank you all. This has been a delightful, not always delightful, but mostly delightful conversation about what's been going on in the world and how to understand what's been going on in the world and what this means for investors. The last words from Mark, actually from all three panelists, was really that there are going to be solutions. And I guess the implication is you've got to look for the entities out there that are building the kinds of solutions to the problems that we have. They're building the kinds of solutions that we need. So necessity is the mother of invention. Another thing that I underlined that I want to come back to is something that Mark said, which is that old people are cool. Now, I am particularly sensitive to this idea because I just became a grandfather about 3 days ago. And so I feel that all of my gray hair is now fully justified. And I think I'm going to get a t-shirt made. Old people are cool. I want to thank you all. Mark Taborski, Robin Zivik, Jennifer Fraser, thank you very, very much for being here today and having this discussion. And all of the people in the audience, whether you're a McGill grad or not, thank you for being here. Thank you all for your support to your alma mater. We miss you and we need you, and we look forward to the next event of this kind. So I'm signing out, Chris Ragan from the Maxwell School of Public Policy on Sherbrooke Street and University Avenue. I'll sign out today. Thank you again to the panelists. Thank you for the organizers, and we'll see you at the next event whenever and wherever that shall be. Thanks all.
Thank you.
Thank you.